sorry, let me grab my little disclaimer here. So Horizon Trust Company is a passive custodian and as such only performs the duties of a custodian. Horizon Trust Company does not provide advice, sell investments, nor offer any tax or legal advice. So I did just want to say that real quick because that question was very tax advisory or bookkeeper. So this is me as a individual who is not licensed to give an answer to that question. I believe so, but check with your CPA or financial advisor on that. I believe that was Sim asking that question.
Alex, I know somebody was asking if we could introduce ourselves. For
Yeah.
people that are new, let's go ahead and go over who we are, why we're here, and what we're here to teach.
Yeah, absolutely. Sorry, I was a little on autopilot there. I was getting excited with the chat. The chat's a little active this morning, so we love it. We love to see this. My name is Alex. I work here at Horizon Trust Company. I've been here for 4 years, and we host these bi-weekly webinars to help educate either existing clients or new prospects on the power of self-directing. We have guests on to talk about their industries and what you can do with self-directing because it's a very powerful tool. So that's the advantage to kind of having that self-directing. So that's what we do here. So again, I'm Alex, and then I'll toss it over to you.
My name is Claudia, and I have been here for 4 years as well, in the industry about 15 years. And I oversee the new accounts department here. We go to we go to events, real estate events, and all sorts of affiliate events. And we have all of our team members that are on the phones to go ahead and onboard new clients. So that is me.
Yeah, well, great to have you, Claudia. Today, as I mentioned at the top of the webinar here, it is tax day. So we wanted to have our CFO, Steve, jump on. He's been on a couple of webinars with us, but he said no. Today is not the day that he is jumping on. Today is his busiest day of the year. So he said 100% certainty he was not jumping on today. So maybe he'll,
With some pointers.
he did give us some pointers, so we'll kind of go over those pointers, and we'll maybe look to have him on in a future webinar. But with it being tax day, we did want to talk about taxes and what you can do with a self-directed account to help you prepare for tax day in the future, or just ensure you're not having a surprise when you file your taxes. Some people become astonished, after they've done their whole year and then they go sit with their CPA and they're doing their taxes and they're like, oh yeah, you owe the IRS $5,000, $10,000, $200,000, whatever the case may be. If you were on here last week or 2 weeks ago on our last webinar, we had Kurt, and that video is available on our YouTube channel. You can go search Greg Herlean, and we'll also drop a link into the chat to rewatch that video. But on that webinar, Kurt mentioned that in his business as a real estate investor, he was once hit with a tax bill of $200,000, if I'm remembering correctly. And that pretty much caused him to look into self-directing and just want to learn so much more about it. So it was a great lesson, kind of hearing from Kurt and hearing how that tax bill is what opened his eyes to self-directing. And he did that by actually connecting with our founder, Greg, at an event. They were at an event together where they talked and they were happened to be sitting at the same table. And Greg just told him what he did, what it was to self-direct. Kurt came in and pretty much just started flying with his self-directed retirement account. So, like I said, we just dropped a link into that YouTube channel. You can go watch that video from 2 weeks ago. It is available on YouTube to rewatch that and kind of just learn a little bit more about Kurt. But from there, we'll kind of go ahead and kick it off. Sir, how you doing? You want to join us? Come on in. You're good. How you doing, Greg?
Greg, our founder.
This
We're
is
just
Greg,
talking
our
about
founder.
him.
Just talking about him. So we just did a little introduction. So why don't you give a little introduction for those that are new here? And
Well, hello, I'm Greg Herlean. I started this company mostly because I just knew that most of the country has no idea you can do this. Yes, I don't normally wear this loud of a shirt, by the way, but today, for some reason, I was feeling it. So that being said, Horizon Trust Company is really about service, about handholding and creating a great experience, a concierge experience throughout the whole process. of teaching you how to utilize your retirement funds in a manner in which you want. And that's what we've done for 15 years now, with, we got almost 8,000 clients now and over $1 billion in assets. And we take it very seriously. And it's also a lot of fun. It's a lot of fun. You talked about, I just walked in, heard you talk about Kurt. It's just fun to see what people can do. It's also, it reminds me in this last weekend, I was at an event. I'm part of this group, this mastermind group, and they, I've been part of this group for, I don't know, a long time. We meet a couple times a year. And sometimes I just think that everyone, since they know who I am, they know what I do. And there was like 4 people that were like, I've known, and they're like, hey, so what it is again that you do? And one, maybe because it's not super sexy, maybe because I typically only wear black t-shirts. And so I'm going to be a little more loud about it. So people will want to maybe ask me more about what we do. But that being said, it's just a good reminder that this is a message that should be shared, I believe, almost all the time. And so I know we've got typically about half of those that are listening are our clients that already work with us. I think also, half are not. And for either side of the table where you might be, if you are in a place like I was this weekend, I was with this weekend with these people that have amassed tens of millions of dollars in real estate, but their constant denominator, it seemed as though, was how do I raise more money? And so I just feel like at any stage in your career, as you're scaling your business or investing, this message applies. And so I guess this is my long intro. Sorry, Alex.
You're good.
But these things came to the forefront of my thought here from this last weekend. Is if you're in that boat, if you have a retirement account, and or are looking to buy assets or scale, there's people all around you that have retirement accounts that could be your business partner. And so, anyways, so that's a little bit about me, but also what I was thinking about this weekend after being with some people in my mastermind in Northern California.
Nice.
Yeah.
Well, that's a good thing. Are they opening an account?
Probably. You know me, I'm not a hard salesperson. So when you want to reach out to me, you reach out to me. And I think it's worked because I feel like almost every day I get a text or email saying, hey, do you remember me? And I'm like, I don't know who this is. and then they'll say, I'm ready to open up an account. And what I find is many people are people that we've shared this message with. Sorry, which camera am I looking at?
That one.
Okay. Keep looking at this one. So many people will say they'll get back to me, and then it takes them sometimes months, or they got to retire after a year or two, or their spouse retires, or has an account that they roll over or refer to us. So yeah.
Yeah, no, absolutely. That was a great intro, Greg. Always is. And Samantha loves the shirt. I spotted this shirt earlier, and I told Claudia, I was like, he's feeling the Easter vibes. So we'll say it's your.
Did not come back from Hawaii.
So with that, like I mentioned, I did want to go over tax day and talk about taxes. I wanted to pull a hypothetical, and it comes from a real situation where a couple weeks ago I went out to dinner with some friends, and at dinner they mentioned how they filed their taxes and were hit with this large tax bill. They are full-time employees, W-2 employees, both of them. It was husband and wife. And the husband, he's a police officer here in Las Vegas, and he does a lot of overtime, which is very common for police officers, very common for firefighters, first responders in general, and maybe even some of you. If you're entrepreneurs, real estate investors, you have other avenues in which you're making money. So those other avenues can cause a way to hit you with a surprise tax bill when you file your taxes. So I wanted to go through a hypothetical today. I have just a couple slides prepared to go through this. So my team's going to set that up and share the screen there. But we'll kind of go through this hypothetical together, and then we will get to your questions. I did see that you guys are already coming in with great questions, so we'll definitely get these questions answered as best we can once we get there. But I do want to go through these slides here. So,
Are the slides clear? Because heard someone say it was a little blurry. So
It was because she was using her phone.
Yeah, someone saying that they can't see it. Other people saying they can see it.
okay, so it might be your phone.
Yeah,
you're
it might be dependent on
Hopefully these slides are clear. So go
Yeah.
ahead.
And if not, you can always watch the replay. We'll have that available this afternoon. I know that question's always asked as well. This is being recorded, so we'll have that available this afternoon on Greg's YouTube channel. So just same link that we've already shared in the chat. Keep that saved, and you'll be able to watch the replay, which hopefully will have clear everything. So yeah, tax day. Relieve their stress. That's up to you on whether you filed your taxes or whether you got hit with a tax bill. I did my taxes and got $4.36 back.
Ooh, you nailed it then.
Yeah.
Good for you.
I was right on the money there.
You should owe $4. Then you're a little bit better.
So clearly I'm missing something. We'll get into that. So with that, let's see here. Trying to click through with a clicker and it doesn't seem to want to let me. All right, little disclaimer there. There we go. I can click through.
That disclaimer, there you go, is important. Go ahead.
So disclaimer, yep, we read it at the top of the webinar, but we'll do it again. Horizon Trust Company is a passive custodian and as such only performs the duties of a custodian. Horizon Trust Company does not provide advice, sell investments, nor offer any tax or legal advice. Very important disclaimer there. So what we're going to talk about is avoiding that surprise tax bill, and is going to be a hypothetical scenario where someone has worked throughout 2024 and filed their taxes and then got hit with their bill, and then learn what went wrong and how to be proactive against that surprise in the future. So we're going to meet our hypothetical individual. Today, his name's Adam. He's 30 years old, has a full-time W-2 employee. He does 1099 contractor side work. So maybe Adam's just really good at his job, or at his full-time job. And he thought, hey, I can make a little extra money by doing this on the side. So for, tax purposes, he lives in Los Angeles because where you live will affect how much taxes you pay. Here in Las Vegas, we don't have state income tax. So that's a different scenario than Adam, who lives in Los Angeles. So we're using Los Angeles as the base there. Now let's go over Adam's earnings. So Adam's base salary at his W-2 job, so this is his full-time job, he makes $75,000 a year. His 2024 additional income, so this is everything else that Adam made or earned, is overtime or bonuses. You can swap that out with whatever it is, that's related within your industry that might apply. So he made an extra $18,000 in that section. That's from his W-2 job. Well, that gave him that. Adam also buys and sells stocks. He sold stocks and made $15,000 from that. Withdrew money from a traditional IRA, $8,000. And remember, Adam's in his 30s. So this is an early distribution to that traditional IRA. And then he does his freelance side work, his 1099 work that I mentioned, and made $12,000. So his total gross income for 2024 was $128,000. And Adam's single, so he files as single. And I wanted to give all of that information because that'll help paint the picture. A lot of entrepreneurs, a lot of people who have a self-directed account maybe have multiple avenues. They're not just sticking to one traditional W-2 income. They are doing real estate on the side. They do private money lending. They trade stocks and everything. So you have other avenues where you're making money, and that's where that surprise tax bill is going to come into play. So let's look at what happened when Adam filed his taxes in 2025 for the 2024 tax year. So we'll go into consideration that Adam has a good employer. So his base salary was taxed properly, and the bonuses and all of that was also taxed properly. He didn't report the self-employment tax, so that's that 1099 work. There was capital gains taxes on the sale of the stocks, and he had the early IRA withdrawal, which triggered penalties and taxes. So all of that combined pushed Adam into a higher tax bracket for his single filing status. So his ordinary income tax was roughly about $17,000. Overtime bonus, roughly $5,000. Self-employment tax, and you can see that those two top ones are in green because those are what his employer withheld. And then these next ones are in red because it's what he didn't account for. So his self-employment tax, 1,800, capital gains tax, 2,200, early withdrawal penalty, 800. That's from that traditional IRA because he's still in his 30s. So that's kind of where that goes into play. So his total 2024 taxes was 27,000. But remember, the first two line items were paid by his employer, so he doesn't have to worry about that. So we'll take those out of the equation, and we're left with a $5,000 tax bill that he's hit with at this point. So that's a shock. If Adam wasn't expecting to pay $5,000 when he filed his taxes, no one wants to see that number. If you see it, you have to deal with it. It is what it is. There's no avoiding it, but you don't want to have to deal with that. So why did this happen? So we're assuming that the employer withheld everything sufficiently. There was, again, no estimated payments on the freelance or the investment income, and then the IRA withdrawal without the planning took into consideration. So all of that kind of just pushed everything to a higher bracket. So this is the brackets. If you don't fully know what the tax bracket is, this is the single filing bracket. And you're taxed at different rates per income ratios. So that first line item, 10%, is on any income that you make from $0 to $11,600, and then so on and so forth. That's how it builds. So only that amount gets taxed at that rate. So the next line item is $11,001. So as soon as you make that extra dollar gets charged at 12%. Everything else stays at the 10%. And that's essentially how a quick tax lesson for this. Again, not a CPA. Talk to your financial advisor for the full details. So how Adam could have planned better. He could have not taken the money out of his traditional IRA to avoid an early withdrawal and penalty. And I know some of you are probably talking into your computer right now, phone, whatever, and saying, but Alex, he probably needed the money. Why else would he take that money out? That's very valid. He probably could have needed that money, and that's most likely why he sold the stocks for that 15,000 and why he took the 8,000 out of his traditional IRA. So we'll kind of touch on those points in a moment. Contributed to the traditional IRA to lower some of that taxable income. Again, I hear you guys talking to me. Alex, he needed the money. Why are we contributing when we need money? You should still be contributing. Even if you need money, you should still be contributing. That'll help lower this income regardless.
Deferring.
Yeah, so you're tax deferring. So those contributions will still help. He could have also used a Roth IRA for tax-free growth. So this year, Adam needed the money, but maybe on a lower income year, Adam used a traditional IRA and a Roth IRA, did a Roth conversion from his traditional to his Roth, paid those taxes at that point, but now that money's growing in his Roth IRA tax-free, and he's able to continue to grow that money and take it out, which then he wouldn't have to pay the taxes on because he's already done so. He could have made his quarterly estimated payments for that 1099 income. So if he's thinking about what he's going to be doing, he takes that into consideration and naturally consulted a tax advisor to plan ahead, something that we say here repeatedly. So a couple of other things to do and be proactive. And this is the last of it. Like I said, I wanted this to be super quick because this is a hypothetical and I didn't want to throw too many scenarios. But now, how does self-directing play into all of this? Well, a traditional IRA is a tax-deferred account. He had the brokerage account where he was holding his stocks. For those of you that may be unaware, when you sell the stocks, you're not necessarily paying taxes when you sell the stocks. It's when you take those stocks as a distribution for yourself. That's when you would pay the capital gains. If you're doing that inside of a self-directed account, and let's put Adam as having a 401k. He has a 1099, so we're now going to assume that Adam has a business. So he qualifies to open a 401k. With that 401k, Adam now also qualifies to take out a personal loan. So that brokerage account that he sold that 15,000 in assets, as long as he has more than 50% to cover what he's looking to take out, he wouldn't have to pay the capital gains on those because he's taking it out as a loan, and that he also wouldn't pay the taxes for that early distribution from his traditional IRA. So all of that now gave Adam additional income that he needed. It was the 15,000 from the stock sale and the 8,000 from the traditional IRA. So we're now at $23,000. So Adam now has $23,000 that he took out as a loan from his self-directed 401k, and he's now paying himself back with interest and not paying the IRS those penalties. Did I get all that correct?
Sounded right to me.
All right.
Good job.
I know that was a lot. I did go through this very quickly, and it was just because it's a hypothetical. And I wanted to cover the basics. I didn't want to start confusing with so many numbers and details. So the hypothetical was essentially the bread and butter of it, to show what a small change in knowledge and with the right tools, like a self-directed vehicle, can help you avoid that tax bill. That 1099 income that he earned, there's no way around that one, at least to my knowledge. Maybe a CPA will help him, but again, that's the CPA.
It's too little, but one thing that he could have done if he did have contractor work that is going to be more substantial is he can go ahead and set up payroll for himself. That way he's paying taxes as he goes and he doesn't have to pay the big tax bill at the end of the year. So that's one thing that he could have done, but it wasn't that that big.
Substantial.
Yeah. So I think these are great numbers for, our normal normal people that have like a normal job. They have side work right now. It's very, very common. So I think it was a great example of what could be affecting our, people that don't know how to plan accordingly.
Yeah, absolutely. And that was one of the messages that I wanted to get across with that presentation. It's understanding that there are options to what you need. It sometimes just involves asking the right questions. Helped one of my coworkers last week take a phone call with a client because they were asking for one thing and she wasn't understanding what they were needing. So I asked her if she wanted me to help her with a phone call. She said yes. And after talking with the client a little bit more, it was understanding that he was looking to open a Checkbook LLC, which didn't fully make sense in his initial conversation that he was having with her. But that's one of our skill set at Horizon Trust, where we'll ask you more questions. You might get frustrated for a little bit while we're asking those questions, but those questions help paint the bigger picture of what you're trying to do so that we can get you to your destination correctly. And what he wanted to do was an easier way of controlling real estate that he wanted to buy inside of a self-directed account rather than sending a bill pay to us every time. And so the Checkbook LLC was the answer. And he learned about it on a webinar. He was on one of our webinars. He heard all about Checkbook LLCs. He knew all about them, and that's what he wanted so that he didn't have to submit a bill pay request or whatever documentation every time he needed something paid. And so we figured it out, got him set up with an LLC. So now he's all set to start his investment.
Sometimes the terminology that we use or that is used in the industry is foreign to people that call in or our clients that are just starting off. So it's really important that we have people that can ask the clarifying questions, and that's what we have in the concierge team. We have a wealth of knowledge, and we have a lot of people on the phones that are answering live that are actually taking the time to understand what you're needing, even if you don't know how to articulate it.
Mm-hmm.
Yeah, I was going to add, as I listen to you talk about this Adam example, as it might sound like that's not you or it's difficult or complicated, it seems as though I'd say like at least 50% of our clients have a very similar situation. When I say situation, 4 bullet points. Every person has that. I have it at least at maybe times 10, and others, everyone else has these 4 different things, whatever they may be. And just a little bit of planning can save you, a few thousand or maybe potentially tens of thousands of dollars. And one of the things, I feel like we are really good at is listening. So at Horizon Trust, when you do call and you talk to a concierge, if we don't have the answer because it's, a CPA related or legal related, we at least will give you some questions to go back and find out what the right thing is for you. And then we can help you set that up and structure it the right way here at Horizon Trust Company. And this happens every single day. And so I think that is one of our, big differences from our competitors is we listen, we'll give you feedback and give you some questions to go back and ask your CPA. But these little few things might sound simple, But even for me, uh, I'm reminded by them because sometimes I'm like, what? Wait, this is how much I owe in taxes? Well, why didn't I get, well, it's because I didn't meet enough with my CPA that year. And so little tweaks today can help you along the way.
Yeah. And a lot of this also helps in just starting early. So, yes, like Claudia mentioned, Adam didn't make a lot in his 1099 income. So maybe he doesn't have to worry about it. But if he starts planning today when he's making a little bit, he won't have to worry about it when he makes a lot, because that's when he's going to be hit with that $100,000, $200,000 tax bill that could potentially be very shocking.
Right. One thing that you can do is like people usually set up LLCs when they're already making money and when they are already like, trying to catch up. I started my LLC when I wasn't making money. And I was like, one day I'm going to go ahead and use it. And that's what I did. And I met with my CPA and I told him, like, this is what I'm planning to do. This is my strategy. I met with the people that needed to make that strategy happen. And then I was able to be ahead of the game because I've been in corporate structuring and I understand that in order to save taxes, you have to be ahead of it and you have to know what your end goal is or what you're planning to do in the next couple of years and then, meet with the right people. So definitely do that.
Yeah. So if you're in a situation maybe similar to Adam's, and like I said, Adam's was a very loose hypothetical, but it applies to a lot of people. Adjust the numbers a little bit, change what you do. Adam could be you. So if you're in that situation, contact our team. We can help you with at least listening, like Greg said, listening to your circumstances, listening to your situation, and seeing if Horizon can assist, if a self-directed account can assist in getting you set up. It doesn't hurt. Greg says it. He's like, we're not salesy. We don't push hard on sales. So it'll just be a conversation to give you more information. So Alicia will drop a link into the chat for you guys to have. So if you are interested in learning more, you can. There were some questions that came in during the presentation, so I didn't see them in real time because I couldn't see my screen, but we'll definitely go through and cover some of these real quick and then kind of get back to the conversation. Let's see. Sim's asking here, Greg, Roth IRAs gross tax-free, in quotes. Seems to be used loosely sometimes because we may not pay taxes on the principal. However, lost my place. However, don't you still pay taxes on the growth? So it's actually the other way around too. You pay taxes on the principal as you put it into the Roth, and then you don't pay taxes on the growth.
That's right. That's what's powerful about the Roth is you're paying taxes on the seed and not the crop, is how people like to explain it. But in another frame as well, let's say you contribute $7,000 to your Roth today, right? Tax day. And that is after tax dollars. So you have paid the $7,000 taxes on the $7,000. But since you've done so, everything that you earn on that money, up to $10 million per year, that's the new rule, it grows tax-free and will come out completely tax-free. The other thing I like to say about that is, let's say over 10 years, you contribute $70,000, $7,000 per year. And let's say you're still not at the tax age. You're at 50 years old or 35 or 40 years old, and your 70,000 you put in now is worth 300,000 or whatever the number is. You can at any point take out your contributions. So if you did need that emergency $70,000 or $50,000, you can take up to the $70,000, no penalties at all. I think that's powerful, and people, I forget it sometimes because I think some people are afraid to contribute to their IRA because it might be a little too much. It might be stretching them. Like, oh crap, I can't do $7,000 because I can't take it out. If that emergency comes up, you can pull it out. So anyways, that's a long answer to your question.
Yeah. So that's the power of the Roth right there. And yes, you make an investment. There may be taxes associated with maybe like the sale. Like if you're doing real estate, there may be property sale taxes and stuff like that. Those you don't avoid. That is paid. But it's the taxes on the earnings. That is what the Roth is avoiding. And that's a key point because people are like, wait, this is done inside of a Roth. Why am I paying these taxes? Because you're still selling a property, and jurisdictions still want their piece for their properties.
Oh.
Let's see here.
And I think Alicia, she put it in there. For those of you that have an IRA or an old 401k or spouse or friend that has one, feel free to use that link. Schedule an appointment. We'll answer questions for you. It's really simple process, and literally do it dozens of times every single day. And so let us help answer questions, see if your account qualifies. That's the other thing. And one thing that we talk about often is something, there's these different types of accounts, TSAs. I mean, you throw out some of these other ones that are 457s. There's these other kind of plans that you might not be aware of that actually do qualify to roll over into a self-directed IRA. So, and the other thing is this happens probably 50% of the time. People think their account is too small. Their old 401k only has 50,000, only has 25,000. That is not too small to invest in some of these alternative assets. So yeah.
And with that, depending on the size of your account, you can diversify those assets. So if you do like the stock market and you do want to stay in the stock market, certain aspects of it, you can still do that with a self-directed account. We're not saying you have to stop going the traditional route. This just allows you to diversify with alternative assets, with real estate, precious metals, private money lending, whatever it is and understand. That's what you can invest in with a self-directed account. There are a few limitations to what you can do: arts, collectibles, alcohol to an extent, stuff like that, insurance. Yeah. So there's definitely variables to what you can do, but Horizon Trust will hold your hand through the process and whatever you want to invest in. So whether you want to start slow and just go into one thing, see how it goes for a little bit, we can help you with that. Or if you want to hit the ground running because you already know what you want to do, there's people that open Checkbook LLCs. We talk about those all the time. The Checkbook LLC gives you even further control. You bring over your 25 or 50,000 that you have sitting at an old account, bring it into a self-directed account, open an LLC that is specifically for your retirement account, so it gets covered under the same tax benefits of your retirement account. And then that allows you to have complete control over the money. The only time that money needs to come back to Horizon is when you are ready to take it out of your retirement account. So you put in the 70,000 into the Roth and you moved it to a Checkbook LLC, and now you need 50,000 for some emergency. Just bring 50,000 back from your Checkbook LLC, and then we'll issue the check, wire, or ACH to you from your Roth account, and that's the proper flow of money. And I'm bringing that up because one of the questions that came in very early in the webinar was, when you set up a self-directed Checkbook LLC, whose EIN do you use? And so 2 questions. First was, whose EIN do you use? You use the EIN that is created for that Checkbook LLC. It is a unique entity that is created for itself. So it has its own EIN number, and that EIN helps the IRS identify that it is a specialized LLC protected by the retirement account. And the second part of the question was, do you have a bank that you have a relationship with? We have a Titan Bank who knows and understands self-directed retirement accounts. They understand how to create the bank account LLC, so that way that the money is in there is being protected under the same tax advantages of your retirement account. Did I miss anything there?
No.
Question.
It's been a minute. Let's see. Roland asked, I have a Horizon Trust account. What's my next step to use the funds in the account to invest in real estate?
I can answer, but go ahead, Claudia.
So the next thing is to identify an investment that you have vetted out and that you are comfortable with making that investment with, and then you can do one of 2 things. You can go ahead and call us. We have an investment department that will go over what the supporting documentation is for that investment and any internal forms that we need to do. It's usually it's called a direction of investment form. You go ahead and fill it out with our representative, and submit the supporting documentation. We have our compliance team review the supporting documentation, make sure everything is in order, and then we'll go ahead and send out the money into your investment company. Or you could go ahead and set up what we've been talking about, the Checkbook LLC. If you want to go ahead and manage your funds and make sure that you do the investment when you need to, because sometimes you need to go ahead and wire the money the same day, or you're doing an investment that needs earnest money, whatever the case may be. If you want to have access to that money, then what we would do is we would set up a Checkbook LLC. We'll go ahead and do a bank account with Titan Bank, and we'll go ahead and do the direction of investment in the name of that LLC. So basically, what you're telling us is you're going to go ahead and invest your funds into the Checkbook LLC. And then from there, you'll go ahead and send the money from the Checkbook LLC into your investment.
Yeah. And Roland expanded on the question. And then there was another question that I want to kind of tie together because they feel like they all go together and go with your talking point, Claudia. Are we limited to real estate is the first part from Roland, or can we invest in a business? And then Larry asked, can you talk about using your solo K self-directed account to be a hard lender, please? So they're two different questions, but follow the same point. Greg?
Yeah. So just reiterate as well. You can do a quick call if you want with our team to explain what's needed. But the most important thing is you just need supporting documents with the direction of invest. So if you go to our website and you don't want to talk to anybody, if you go to our website and find the form's direction to invest form, it'll kind of guide you through what you need. But there's definitely supporting docs. Just like you would if you were going to invest in any kind of deal, there's documentation that's between, if it wasn't inside an IRA, between that investment and you. And in this case, it's between that investment and your IRA. So that supporting documentation is needed. I just wanted to double emphasize that because some people are like, okay, I'm ready to go, send my money. And it's like, okay, well, I can't just send your money, even though thank you for the wire instructions. That's reckless. We need documentation. And so once you've done it once, I assure you, after about 5 or 10 minutes of understanding it, it's easy going forward. So that being said, you don't have to just invest in real estate, man. You can invest in anything. I don't know who asked that question. The name there that asked that question, was it Roland?
It was Roland.
Roland.
Can we invest in a business?
You can invest in businesses. You can invest in precious metals. You can invest in Bitcoin. You can invest in the stock market.
Crypto.
Crypto. You can invest. Real estate is what most people invest in, but real estate is so wide range. It can be notes. Speaking of notes, it can be hard money loans, which we can talk about here in a second as well. So there is very limited or very amount of unlimited or limited things you can invest in. So I would say if you plan on going into something you're not familiar with, do your own due diligence, make sure you're comfortable with it before you do so. So and the sky is almost the limit. My son invests in commercial construction, what do you call it? Equipment, forklifts. That's interesting. He flips them with his Roth. It's not something I do.
He makes a good return.
Yeah. There you go. So you could do that as well. But as far as your solo K, using your solo K, you can do hard money lending with that. So just like you could with your traditional self-directed IRA as well, that would be the 401k would be the lender to someone who's looking for a hard money loan to that borrower. The documentation would need to be prepared the correct way to make sure your 401k is the lender. We'll double check that to make sure it's titled the correct way. But the unique thing about using a 401k, or I should say any kind of retirement or qualified plan in the self-directed space with hard money, is you create the terms with the borrower. It's not fixed typically. So if the borrower, you got to make money, it's got to be reasonable rate. You can't give it for free. The purpose of an IRA and retirement account is to make money. But you could charge 50%, you could charge 10%, but whatever you come up with, that obviously those terms will go inside the contract for your 401k.
Yeah.
And something that I did want to clarify is a lot of our clients ask, oh, well, can I do this in my 401k? Well, can I do this in my IRA? all of our accounts are self-directed.
Yeah.
So anything that you can do in one account, you can do in another with the type of accounts that we carry. We carry qualified accounts by the IRS rules. So what we do is we make sure that we set up accounts that are tax deferred, or tax free, Roth or qualified. But all of our accounts are qualified. So anything you can do in one, you can do in the other. There's clients that come up to us and say, "Hey, I'm doing really good in my self-directed IRA. I have this $30,000 HSA account that I've been holding. I don't really have anything going on with it. Can I move that?" Yes, you can. So if it's a qualified account, talk to your IRA specialist, and for the most part, we can go ahead and either fund your current account, put more money into it that you found in this IRA that you haven't looked at in a long time, or you can set up a new account that can go ahead and you can do the same thing.
Yeah, absolutely. And that was a point that I wanted to bring up right there, because that's a question that we get asked a lot. They're like, well, I have a traditional IRA. How do I get a self-directed IRA? It's the same thing.
Yeah.
Self-directed is just the vehicle that allows you to diversify into alternative assets, because we are a self-directed custodian and we're licensed to be a self-directed custodian. And with Claudia's point, anything that you can do in one account, you can do in all accounts in regards to the investments. That was the key point right there, because there's different rules for accounts based on maybe contributions, stuff like that. And the 401k account, for example, that we used with Adam, it has the loan feature. So with a 401k account, you can take a personal loan and pay it back within 5 years. There's rules on that as well. So if you do have a 401k and you want to take a loan, borrow money from yourself and pay yourself back with interest. No need to pay a bank, no need to, high interest rates or whatever the case may be. There's a lot of great questions coming in right now from you guys. This is amazing.
One of the things that Greg and I were talking about while you're looking for the next question is about the tax extensions. I know that we talked about it earlier. If you have an IRA and you're doing a regular IRA contribution, the contribution day was today. So you can't do a contribution for 2024. With that being said, if you have a 401k or any business owned or sponsored account, if you did an extension with your CPA, you have until the extension deadline to go ahead and make the contribution for 2024. If you have an extension, you know about it. So don't call us and ask us if you have an extension, because we wouldn't know that. That's something that you would do with your CPA. But if you have it, then you would go ahead and know that, and you'll work with your CPA to determine what your contribution is for 2024. And when you go ahead and call us, we'll let you know how to do it. It is a little unorthodox, and it's not something that we do all the time, but that's up to your CPA if you guys are doing that kind of tax planning.
Yeah, absolutely. One of the questions that came in, are there any restrictions except for allowable amount to contribute to a Roth 401k with after-tax dollars? So a Roth in general is already post-tax dollars, because that's most likely money that's already in your bank account that you've earned and paid taxes on. So that's definitely one of the things that you'll want to consider. We have a sheet on our website under our form section that has the contribution limits for the year. We just took down our 2024 one because today's tax day. So today is the last day to contribute to those accounts. And they have to be established within the past year. Well, at least for 401ks, I think IRAs, you can still do it even though you established it in this year. Is that correct?
So for IRAs, you have until tax deadline. Right now, you wouldn't be able to do it today, but as of yesterday, you could have established your IRA
You
and
can't do
done.
it today?
No, no, you are. You say live, we can do it today. That's up to you. You're gonna have to
You're the
talk to
owner,
your
you
processing
compliance.
team.
Backdated as yesterday? I didn't say that.
No. So
Anyways,
It would be the year of 401ks. The reason why it has to be before December 31st is because we have to establish your plan documents. Every 401k has to have plan documents for your new 401k that is sponsored by your LLC or your operating company, and those are have to be done on the December 31st is the last day for any tax year.
yeah. Yes, Greg. Technically, there's an asterisk there. They can contribute today for last year. Compliance is not a big fan of it.
so you can. Shh.
All right, you guys are here on the webinar. You know.
All right, next question.
Next question. There's a lot of questions coming in regard to fees. So, Greg, you have a great answer in response to fees, so I'll let you take that one.
Yeah. Our fees are all inclusive. So as far as Horizon Trust Company fees, okay.
Mhm.
So in general, for most of you, if you're familiar with where you were before, or if you currently have not yet opened up a self-directed IRA, you're most likely paying anywhere from 1 to 3%. Even those that think they're not, they are. I could easily show you if you've got different mutual funds and stocks, et cetera, what the different fees are that you're paying. That being said, at Horizon Trust Company, our fees are 1% or less. Um, you can go to our website, but the larger your account, the lesser the basis points. So, like for example, I can't give it. You probably could better than me. If it's $100,000, it's around 70 basis points approximately
I don't look at the fee schedule.
around there. So it's less than 1%. It's all inclusive, which I love because we're not like this billing company. A lot of our competitors like to tease you with a lower annual fee, fixed. And then what they do is they nickel and dime you every time there's a wire, every time you buy something, every time you sell something. And so, anyways, that being said, it's an all-inclusive fee. The only additional fees we ever have are tax-related fees. If there's tax forms that we are creating or need to create for your account. That being said, that's what it is. I'd say on average, it's about 0.5 to 0.75% per year. And then the last thing I like to say about that is what we provide is not only service, but we are timely. And that is one of the best things about Horizon Trust Company. I can say it with confidence. When you ask us to invest and send money out, we do it within 1 to 2 business days. You don't have to pay an expedite fee, as long as you provide us the correct documentation, of course. But what that does is we're able to move things weeks, if not months, faster than our competitors. So even though a competitor might save you $300 or $400 or maybe even $1,000, hard to believe, I'm saving you 2 to 4 weeks. What is 2 to 4 weeks in investment? Typically, that's 0.5% to maybe 1 or 2% just in that month.
Or an investment
Meeting
in
the
general.
deadline.
Meeting
Oh,
the
yeah,
deadline.
or closing on a deal. So, anyways, that's the long answer. You can tell it's near and dear to my heart when it comes up to that fee schedule. So, anyways, next question. I know we only have like a few minutes left too. So,
Yeah.
so if we
Yeah.
don't hit all the answers to your questions, feel free to also email me. You got my email. Alicia will put it in there as well. Greg Herlean at Horizon Trust Company. I respond to all the emails. So if we didn't respond to one of your questions here, I know we still have a few minutes. We're going to do that. Feel free to email me. Alicia will put it here in the box, the chat box, and I'll get back to everybody.
Yeah. There's a lot of questions coming in about Checkbook LLCs. So maybe we'll have to do another webinar on Checkbook LLCs in the coming future, just to kind of cover a lot of that, because there's just so much diversification that can be done with that. One of the questions from Craig is he has too much money in his Titan account. So he wants to know, how do I invest some of that into a mutual fund? Do I need to move it back to Horizon and then to a mutual fund, or can I do it directly from the Checkbook LLC?
Yeah, that's a great question. You can do it directly from the Checkbook LLC. Open the brokerage account in the name of the LLC in the brokerage that you decide. The beautiful thing about Checkbook LLCs is that you can go anywhere for these. If you wanted to do it directly from your Horizon account, you can do that as well. We have a couple of options in our investment corner. You can't go to every brokerage account and they won't and open an account in the name of Horizon Trust. It has to be somebody that is familiar with how self-directing works. So we have a couple of options. So either way, yes, it's definitely something that you can do.
Yeah, it's definitely something to look into. Similar LLC question, but I want to talk about it, is can we combine funds from an IRA? I'm assuming traditional, they only put IRA, and a Roth, etc.
Yeah, yes. I mean, there's a couple more questions I have with that, but
Asterisk.
let's just say that I have a traditional and a Roth, and I want to lend or invest or partner with somebody, and let's say there's whatever 50,000 each account or 10,000 each account. Both of those accounts can invest as long as the terms are the same for both. So I can't give the Roth a better return than my traditional, if that makes sense. But yes, they both can invest together in the same investment.
Yeah. And it doesn't even have to be 50-50. It could be 30-40, or that's
right.
not even the right number, 70-30. But the money going into the Checkbook LLC, once it's there, it's 100% of the LLCs. But the returns have to go back into the account at the same rate that they were put into the LLC. So whether it's 50-50, 70-30, whatever it is, that's what you want to look at. So that's something to kind of consider there, Reese. And Stacy's asking, I have a solo K, but wonder if I'm better in the long run having a Roth IRA instead. Stacy, one of the powerful things about having a solo K, if you have a self-directed solo K with us, you can open a tax-free solo K, which is the Roth equivalent in a solo K, because you qualify for that. It's an account that we can help you set up, and it comes with all the same perks of the solo K. So you could still borrow from that Roth solo K and take out a loan from there the same way you can out of the regular solo K. And that's something you can't do in a Roth IRA. So if you,
Contributions are a lot
and the
higher.
contributions are a lot higher as well. Yeah. Thank you.
And most likely the answer is yes, you should do it.
Yeah.
Consult your CPA, but most likely I mean, if you can get as much money as possible without messing up your tax consequences or liability today, but whatever amount you can put into a Roth or transition or convert into a Roth account, the better.
And on Roths, does the Roth have to be matured 5 years before you can take anything out? So that's that 5-year rule on Roth accounts. So that's not necessarily matured 5 years. It's the funds that you've put in, correct? So we mentioned that earlier, where it's like you have the 70,000 in there and you want to take money out after 10 years. So you can take everything up to the 5-year mark, correct? Or am I misinterpreting that?
You can take out the money anytime.
Contributions,
the principal. That's right.
Okay. And the earnings is that 5-year rule?
No, the earnings not until after 59 and a half
Not until
and after 5 years.
Okay. 5 minutes remaining. Lots of questions from you guys. You guys are on it. So we're definitely not going to have a chance to get to all this, like Greg said. So we'll have Alicia drop the link into the chat again. I know it's right there, but she'll send it again. So reach out to our team. If you're an existing client, you can reach out to our concierge team via phone or email. They can assist with your questions. You can connect with your rep if you're looking to maybe establish one of these accounts that we have talked about. Or just get more information. If you haven't opened an account, just jump on that call with our new account reps. They're able to help listen to you and understand what it is that you need in order to make this happen. I'm kind of scrolling through a lot of questions right now because there's so many. I don't even know what else to ask. Let's see.
I think the best thing is for them to go ahead and schedule an appointment. We are running out of time. We like to be mindful of everybody's time and keep it to an hour. I do have something to announce. It is Alex's last webinar. He is moving on to the next chapter of his life.
He might come back as a guest. Come on.
He might. But you know, some of you guys have been following him for, it's almost been 2 years since he's been a part of our webinar series. So it's a big deal. We're very excited for him. And I just wanted to go ahead and wish him the best and have everybody wish him the best, because he is such an integral part of our family. And I am going to miss you.
Thank you. Yes, it was definitely a little bittersweet moment here. So thank you to Claudia. I know she kind of just stepped out for that. But yeah, we started this 2 years ago. We built this studio and just have been doing these bi-weekly for so long and everything. Oh my God.
Hey. You don't have to eat it right now, but if you were all here, we would share that with you. And we will obviously continue our webinars every 2 weeks. And I do believe Alex will be back, whatever that means, as a guest for sure. But he helped us build the studio. He's done so much more. I wouldn't say help. I think you did it. And we've been so happy with you and the job you've done, and you've been very professional, and you've learned so much, as have we, from you. And that's what we love. I mean, it's about what's, our family, and I feel like our team is our family. And so we're happy for you and your family. So
Thank you. I appreciate it. For those of you that are existing clients, I am also a client, like I've mentioned in a million different webinars. So I am still in our Facebook group. So if you want to connect, I'm on the Facebook group and I'm able to talk to anyone. Still not a CPA, still not a financial advisor. I'm not going to be working in those industries, so I'm not going to give financial advice. But yes, I will be in the Facebook group, so feel free to say hello. Thank you to everyone for the warm wishes. Thank you, Greg and Claudia, for these amazing opportunities. I know the webinar started with just being, this kind of educational things, and they've evolved over the years and everything. So it's definitely going to be bittersweet. I'm going to miss all of you as well in these chats. So we'll definitely pick this up again. And yeah, I'd be more than happy to jump on as a guest again in the future. We'll see. We'll make it happen.
Well, good.
This definitely isn't goodbye. It's see you later. So
thanks everybody. Thanks for joining us today. Thanks, Alex. Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.